Hello, good afternoon, everybody. So let me know where you're watching me from. Uh, I really like the topic for today. This is my favorite thing, which it's one of my best strategies. So when I say my best strategy, I'm not saying that I'm going to show you the holy grail. That's something which will always be making, but I'm going to show you something which is really useful. Something that if you understand and practice well, you'll be able to make at least a difference in your trading as a career. So today's topic is a simple strategy towards risk management. A simple strategy towards risk management. So before I say anything, I know most of us are thinking, or they're saying that they have some strategy, or there's some strategy they've heard of somewhere, or maybe they are currently looking for good strategies, and all those strategies are based on whatever they're seeing on the screen. These charts, maybe these candles, the tails of candles, the highs of candles, the body of candles, or maybe the formation of patterns on the screens. Okay, that's correct, but there is something else. There's another strategy which, if you don't put it inside your trading, then you're not going to get everything right. You'll not have it the correct way if you don't get that the correct way. You have to get this right if you are to succeed in the forex market, and that is, you have to understand how to manage your risks properly. That is the only place you'll start to make money. If you don't understand that, there's something missing. There is something missing. Okay, I want to give you some short story first of all about myself first, then I'll tell you why this is the most important strategy. When I started the whole thing about trading, there's something which I learned. First of all, I didn't know about the indicators. I didn't know about indicators. There's no such thing as indicator. I didn't know anything about the indicators. All I knew was red candle, green candle. So I would buy blindly. When the price became red, I would sell. When the price was green, the previous candle was green, I would buy. I would continue buying, buy until when the price goes down. So somehow I used to make money. Somehow I was still making money. Just by following something as simple as that, I was making money. Then I continued with this for some times until I learned again about the way the candles appear. So if I see a candle which is red, the body is small, but there's a long tail above it, I would sell it blindly. I would sell it here after the close of that candle, and I would sell it here and have my stop loss above this level. So that too also worked for some times. It was working. Yes, it is true, it was working. Sometimes I would be stopped out, sometimes I would hit my profit, but normally it appeared that it was working. So up to that point, everything was well and good. I was making money. With that, as simple as those strategies were, I was making money. Then my problem started when I started knowing a lot of things. My problem started when I started knowing a lot of this, when I started adding more knowledge to what I already knew. That is, I now understood how to analyze the charts. Everything was now, I knew what candles meant, what the tails meant, what the body meant, what the patterns meant. That is when I started losing money. So the question is, why was I losing money? Yet I knew a lot. Why was I losing money? Why was I losing money yet I knew a lot? So don't be deceived. This can happen. In the forex market, keep it as simple as possible. Keep it as simple as possible. Nothing is guaranteed. Like, no one knows whether the price is going to go up or the price is going to continue down. No one knows. However good your strategy is, sometimes if your strategy maybe says a sell here, and you come to this chart, then you sell blindly. You come to this chart and then you sell blindly. What will happen is this: the price may likely go down or the price may go up. It is 50% chance that the price may go up, or 50% the price may go down. And if, for example, your strategy says this is a buy, that is your strategy saying that the market says when the price reaches here, it can either go up or go down, which means it's still 50%. So that means all the strategies are only like 50% chance accurate. Whatever makes your strategy like 51, what gives a strategy at least 51% accuracy is when you incorporate a proper risk management to that strategy. So do not be deceived. I hate the idea where somebody will come here and say risk 2 to 1, 1 to 2, whatever, something like this, 1R to 2R. So this is common knowledge. When you hear anyone saying that I want risk 1, risk to 2 reward, it looks very much intelligent until you put it on paper, you put on real trading. That's when you find that, sorry, this does not make any sense. It may not be as useful as you thought. So this is okay. Mathematically it makes a lot of sense that you are risking just 1% and then your reward is 2%. Now this one will apply best if you don't know anything in the market. Yes, well, somebody may say that, okay, if I know some things, I'm making money, then the rewards are going to be many. Yes, that makes sense. If you know some things and then they work for you, the rewards is going to be many. But what about if majority go against you with what you know? You lose extremely much more than the risk. I think does it make sense? Okay, so it makes sense. It's okay. It's really good if somebody says, but what I'm trying to get us out of is where somebody says this strategy works like 90% of the time, and then you blindly begin to follow it. You now say you want to risk this. You are risking this amount for this reward. Okay, one thing, when you say you are risking this for this reward, there is something which you have to input into this to make it reasonable. To make this reasonable, there is something which you have to input into it to make it at least make sense, so that it reaches the level where it makes sense for everyone. Okay, if you say, for example, you are risking 10 pips for 20 pips, 10 pips, 10 pips, so if it reaches this point where you are saying that you are risking 10 pips for 20 pips, this also makes sense. But there is one thing which you have to know, that not in all cases will the 10 pips be appropriate. In some cases, the 10 pips should be 90 pips. That's the best place the stop loss. In some cases, where we have the 10 pips, you should have around 50 pips as the stop loss. So if you find yourself in a case where you are fixing the stop loss, at every case you're fixing the stop loss, you'll be stopped out severally. In several cases you're going to be stopped out. So what am I saying here? Rule number 1, place your stop loss correctly. Don't first of all get concerned of how many pips you're risking. The first thing to do is to ensure that your stop loss is placed correctly. So if, for example, you've triggered a buy here, and the person who is trading 10 pips, they'll have their stop loss here, just 10 pips below it. You who understands how to trade, you know that your stop loss should be here. This is the first step. Place your stop loss correctly, irrespective of what's happening in the market. Your stop loss must first be placed correctly. Have it below that tail first of all. Then now, when you already have it like that, calculate how much are you risking. How much are you risking? Like, for example, maybe this is you are risking from this point to this point. You are risking like 100 USD. 100. It means you'll have to risk 100 USD. Okay. Now you know how many pips that's here. You know how much you expect to risk. Using these two information, calculate the appropriate losses so that you at least is risking something small. Like what I'm saying is this: first of all, measure mostly on how much you expect to risk, then use the information based on how much you're supposed to risk to calculate the appropriate losses. So you have to learn how to calculate how much are you expecting to risk in pips and in dollars, and then use that information to find out what is the correct lot size. Are we on the same page? Are we on this? So understand also, because if you say, and also one other thing, if you say that maybe instead of risking 10 pips, 20 pips, you are saying you are risking like $20, I mean $10 for a reward of $20, that still makes sense. But it does not make sense if you now understand that each of these symbols actually have different values per pip. So one pip here is not the same as one pip on the other one, and it's not also the same on the other one. So if you now say you want to risk 10 pips per trade, you don't know exactly what you're doing. You don't know exactly what you're doing. So first of all, get your risk correctly. Calculate how much you expect to risk in dollars. Then how much do you expect to risk in pips? Use that information to calculate how much you're supposed to place as stop loss, as the lot size. So this is one thing. Understand perfectly well that each of these symbols, each one of them have their own pip value, tick value. So whenever you want to calculate lot size, you need to get the tick value for this, calculate how much you expect to risk in pips, calculate how much you expect to risk in dollars, and then based on that information, now calculate the lot size. So we are not starting from where we expect what to gain. We are starting from where we are looking at what are we losing. That's the first thing. Always look at how much are you losing first. Then from how much you're supposed to lose, calculate the correct lot size. And depending on what the lot size is, you'll be able to lose less or even to lose more, or to gain less or to gain less, or to gain more. Are we on the same page? Do you understand what I'm saying? Yeah, so this has been a very brief one. That's the only thing I wanted us to look at. I want us to see the importance of why you're supposed to be checking at how much you're supposed to risk first, even before you consider how much you're expecting to gain from a trade. First of all, understand how much you expect to lose. So this is the formula. Let me write the formula before we wind this up. This is the formula. So lot size is equal to risk in dollars divided by stop loss SL in pips times tick value. So tick value is basically per every single move in the market, every smallest move, so it has a value. So that's the tick value. If you want to get the lot size, this is how much you're going to risk in dollars, this is how much you want to risk in the stop loss, and then this is how much per tick, that's value per tick. This is overall the formula. This is the formula which you use to calculate the lot size. So thank you very much. That is the end of the session. We'll meet again next week at the same time. So thank you. See you.